The Sindh University campus, Larkana. Department of Business Administration, batch 2K18. The name of Allah, who is the creator of this universe, most kind and most merciful. Assalamu alaikum everyone. Here I am Shumaila Memon and I am going to present my presentation on the 4 topics. What are those topics? Let's see. Subject is managerial economics, presented by me myself Shumaila Memon. I'll be with 2K18 batch. My roll number is 44. To Ma'am Shagupta Salim Sheikh. Business Administration faculty member of Circle. Subtopics are number first, elasticity of demand, number second, pricing, number third, cost and production analysis, number fourth, inventory management. My first topic is elasticity of demand. What's the elasticity of demand? Let's watch. Elasticity of demand. What's the elasticity of demand? Elasticity of demand having important aspects. It is very important aspects in economic theory, so the demand will be changed most of the time because of the price. It may person to person, place to place, or various transactions, so there will be demand. The changes of the demand we can measure in this elasticity of demand. The elasticity of demand word is taken from physics, one variable to another variable. Sometimes you will find the different changes. The changes will be measuring in this elasticity of demand. Why the changes? Because one variable is getting affected. Here is another definition of the elasticity of demand. Demand elasticity is an economic measure of the sensitivity of demand relative to a change in another variable. For example, when there is a relationship between the change and the quantity demanded and the price of a good or service, the elasticity of demand is known as price elasticity of demand. Types of elasticity of demand. What are the types? Price elasticity of demand, income elasticity of demand, cross elasticity of demand, and last one is advertising elasticity of demand. Number first, price elasticity of demand. What's the price elasticity? Price elasticity of demand is the when there is the change in price of one product and another product, so that makes the difference in product. Degree of price elasticity of demand. What's the degree? 5 cases of elasticity of demand are studies depending upon their degree. Number first, perfectly elastic. Number second, perfectly inelastic. Number third, unitary elastic. Number fourth, relatively elastic. Number fifth one is relatively inelastic. Second topic is pricing. What's the pricing and how pricing decreases and increases? Let's see. Second is pricing. Pricing is the process whereby a business sets the price at which it will sell its products and services, and many by part of the business marketing plan. First of all, what's the price? Price is the only element in the marketing mix that produces revenue. All other elements represent costs. Other definitions of the price. Philip Kotler defined price as the amount of money charged for a product or services. Stanton defined price as the amount of money or goods needed to acquire some combination and other goods and its accompanying services. Pricing decision. What's the pricing decision? Pricing decisions are the choices business make when setting prices for their products or services. Pricing is the considered part of a company's marketing strategy. It influences its relationship with customers. When prices are fair and competitive, customers come back, increasing the profitability of the business. Factors influencing pricing decisions. What are the factors? Internal factors. Cost of the product, company objectives, types of company objectives. In the beginning, we will define what our object will be. Get supply from others employed in the company to help achieve our objective. Set up a strategy and a roadmap of how long it will take to reach our objective. Educate employees on the company's objective and vision so they know what to going forward. Our next step will be to invest in technology that will help us optimize our strategy. Organizational factors, marketing mix, product differentiation. External factors. What are the external factors? Competitions, suppliers, economic conditions, and consumers. These are our external factors. Pricing discrimination. What's the pricing discrimination? Let's see. Price discrimination means the practice of selling the same commodity to different buyers. It is monopolist charges different prices from different consumers for the same commodity. It is called price discrimination. Price discrimination is also known as differentiation pricing. Types of the price discrimination. What are the types? Income of the customer. Price discrimination is based on income of individual customers. Second type is nature of the product. Price discrimination is based on the nature of the product. It may be of size, branded or unbranded. Number third, age and status of the customers. Number fourth, age of the customer. Different prices are charged from different customers for same activity done. Number fifth, status of the customers. Price discrimination is based on the status of the customers. My third topic is from the subtopics cost and production analysis. What's the cost and production analysis? Let's watch. Topic third cost and production analysis. Cost and production analysis. What does cost analysis means? Cost analysis refers to the study of behavior of cost in relation to one or more production criteria like size of output, scale of operation, price of factors of production, or the cost of analysis. 1. The act of breaking down a cost summary into its constituents and studying and reporting on each factor. Second, the comparison of cost as of standard with actual or for a given period with another for the purpose of disclosing and reporting on conditions subject to improvement. Production analysis. Production analysis basically is concerned with the analysis in which resources such as land, labor, and capital are employed to produce a firm's final product. Production cost. Production cost or product cost refer to the cost incurred by a business from manufacturing a product or providing a service. Production cost can include a variety of expenses such as labor, raw material, consumable, manufacturing, supplies, and general overhead. How How do we calculate the production cost? Number first, production cost formula is equal to direct labor plus direct material plus factory overhead. Number second, factory overhead is equal to indirect labor plus indirect material plus other factory overhead. Number third, product cost per unit formula is equal to total product cost divided number of units produced. What is the purpose of cost analysis? Determining the purpose of cost analysis. The primary reason for conducting cost analysis is generally to determine the programs under analysis services and or products price the service or product for paying beneficiaries at a level that covers the true costs of providing it. Types of cost of production. There are some of different types of cost of product that you should be aware of. Number first, fixed. Number second, variable cost. Number third, total. Number four, average cost. Number fifth, marginal cost. How does cost of production affect price? If the cost of any factor of production, labor, raw material, equipment increases, the quantity that producers are willing and unable to supply at a given price increases. Producers with lower costs will always be able to supply more of a product at a given price than those with higher costs. What's the mean by total cost? In economic, total cost (TC) is the total economic cost of production and is made up of variable cost which varies according to the quantity of goods produced and includes inputs such as labor and material plus fixed cost, which is independent of the quantity of a good produced and includes inputs that cannot. Production functions. What are the production functions? A firm has two types of production functions. Number one, short run production function, long run production function. The average cost of production. Some examples of direct and indirect cost. Examples of direct cost. What are the examples? Direct labor, direct materials, commissions, piece rate wages, manufacturing supplies. Examples of the indirect cost. What are the examples? Production supervision, salaries, quality control costs, insurance, depreciation. Some types of costs and cost concept analysis. Social cost, advertisement, opportunity cost or alternative of any unit of a commodity. A is the value of the factors of production used in producing the unit. Past costs for policy decision on price. Incremental costs. The change may take several forms. Sunk cost. The different types of cost in economic. Fixed costs, FC, which don't vary with changing output. Variable cost, VC, cost which depend on the output produced. Total cost, TC, fixed plus variable cost. Marginal cost is the cost of producing an extra unit. Last one topic is inventory management. What's the inventory and what kind of inventory is used there? Topic fourth is inventory management. Inventory management is the supervision of non-capitalized assets, inventory and stock items. A component of supply chain management supervises the flow of goods from manufacturers to warehouses and from these facilities to point of sale. essentials inventory management techniques. At essentials are these: set per levels, consider drop shipping, first in and first out, manage relationships, contingency planning, regular auditing, prioritize with ABC, accurate forecasting. The inventory control system are technology solutions that integrate all aspects of an organization's inventory tasks, including shipping, purchasing, receiving, warehouse storage, turnover tracking, and reordering. Main inventory control system types: perpetual inventory system, periodic inventory system. Techniques of inventory control: establishing annual stocking policies, preparation of inventory budgets, maintaining a perpetual inventory system, establishment of optimized purchasing producers, inventory turnover ratio, ABC analysis, and ABC classification. How inventory saves the money? Number first, avoid spoilage. If you are selling a product that has an expiry date, like food or makeup, there is a very real chance it will go ahead if you don't sell it in time. Solid inventory management helps you avoid unnecessary spoilage. Number second, avoid dead stock. What are the dead stocks? Dead stocks is stock that can no longer be sold, but not necessarily because it expired. It could have gone out of season, out of style, or otherwise become irrelevant. By managing your inventory better, you can avoid dead stock. Number third, save on storage costs. Warehousing is often a variable cost, meaning it fluctuates based on how much product you are storing. When you store too much product at once or end up a product that's difficult to sell, your storage costs will go up. Avoiding this will save you money. Inventory management improves cash flow. Not only is inventory management more cost efficient, it improves cash flow in other ways too. Remember, inventory is product that you have likely already paid for with cash, checks, and electronic transfers included, and you are going to sell it for cash, but while it's sitting in your warehouse, it's definitely not cash. Try paying your landlord in dog collars or iPhone cases. Why inventory management is important? Effective inventory management is essential for ensuring a business has enough stock on hand to meet customer demand. If inventory management is not handled properly, it can result in a business either losing money on potential sales that can be filled or wasting money by stocking too much inventory. An inventory management system can also help you prevent a number of other mistakes. Thank you. This was my presentation. I hope you like it. Then please subscribe my channel and thank you so much for watching.